When it comes to your risk assessment and investment strategy, it is important to answer the following questions. Can you retire? How much do you need to retire? How long will your money last? How do you draw this money out in the most tax-efficient way possible? If something happens to you, will your spouse and your family be okay? These are the questions we get every day in our offices, and these are the questions we're going to help you answer today by using our Financial GPS. Hi, I'm Chad Schlegel, president and founder of Schlegel Financial and host of the Chad Schlegel Show, coaching you to and through retirement. When we talk about investment planning, there are two things that we need to identify right up front, and that is number one, how much income will you need off of your investments? And number two, how much are you willing to lose in a down market? Or how much are you willing to lose when we have a correction of 10, 20, 30, or maybe even 40%? First, you want to separate your portfolio, your money, if you will, into three different buckets. The first bucket is what we call the secure bucket. This bucket is there to make sure you have enough money coming in and enough income coming in the rest of your life and your spouse's life. It doesn't matter what happens with the market. If it drops 20, 30, or 40%, this money is there to last. And of course, the second bucket is what we call the growth bucket. This money, of course, is there to grow. It's there for the long term. It doesn't matter if the market has that 20, 30, or 40% correction. You know, because it won't affect you because you have that money in the secure bucket. So when the market goes down, you don't have to go in and lock any losses in this bucket. When the market's up, then we can go in and harvest some of those gains in that growth bucket. And the third and final bucket is what we call that dream bucket, sometimes referred to as that extra bucket. Now, this money you may have set aside for a second home, or maybe you want to use it to make sure that you take your family, your kids and your grandkids on one big trip each and every year. Maybe you have this money set aside for your long-term care expenses so that your family doesn't have to worry about that as you get older. So how do you decide how much money goes in each one of these buckets? Well, the more income you need, the less that will go into the growth bucket because the less risk you can afford to take. Why? Because if you need to take out a large amount annually to satisfy your income, say 5-6% of your money to meet your spending goals and income needs, then you have a lower ability to take on risk. Because in your retirement years, you will have corrections. You will have downturns in your portfolio. In a recession, markets usually go down about 30% from the top to the bottom. So that means if you have high income needs from your portfolio and we experience a correction of 20 to 30%, then you have a higher probability of that money not lasting throughout the rest of your life. Now, if you have ability to take on risk is lower, then you need to have less money in stocks and the growth bucket to have a higher probability in order for your money to last throughout the rest of your life and your spouse's life. What that means is if you are low risk, you have high income need from your investments. If you're high risk, then that means you have a low income need from your investments. So let's say you have $1 million. You live off of Social Security and a pension, and you really don't need this money for income. Then you have an ability to take on more risk because if you lose 40 to 50% of that portfolio, of that money, that will really not change your way of life. However, if you need, say, $50,000 off of that money, which is a 5% a year income off of that $1 million, and it drops 50%, then you need to draw 10% a year next year, just in the next year, off of that money to get the income that you need. Because you no longer have $1 million. If you lost 50% of it, you now only have $500,000. So that probability of that money lasting at that rate is not very high at all. So you need to identify your need for income and how much risk you can take on. You want to make sure you are proactive and ride out the market. The key to investing in the market is to be able to stay in the market when it declines. And in order to do this, you must have the correct amounts in each of the three buckets, the secure bucket, the growth bucket, and that dream bucket or that extra bucket. And the place we see people get into trouble most often is by guessing what the market is going to do and having too much money sitting in that growth bucket. Then when you have to draw income from that bucket, and that bucket is down or the market's down, then what happens is you have to go in and sell shares of your mutual funds or your stocks at a loss. Then you're looking at not only locking in losses, but also possibly cutting into your principal that you need to get that income off of. This all results in your portfolio, your nest egg, if you will, shrinking and taking away from the probability of that money lasting as long as you need it to. And of course, your risk assessment is something you want to make sure that you're constantly reviewing and you want to rebalance because, again, folks, life happens. The other thing to understand is that you need to understand at this stage of life is what we call longevity risk. The longer you live, the more likely you will experience multiple recessions, market crashes, and of course, inflation affecting your purchasing power. You are also more likely to incur higher healthcare costs, rising taxes, long-term care costs, and low returns. So when we take and go through when we take you through our financial GPS process, you're going to feel more educated. You're going to feel more empowered to make the best decisions with your hard-earned dollars, monies that it's taken you 30 to 40 years to accumulate. And you will gain peace of mind knowing you are on the right track to a successful retirement, where you can enjoy the money you have earned and spend valuable time with your family because that's what's most important. So let's review our financial GPS. Our guided plan system it uses the following building blocks to create a comprehensive plan. Number 1, risk assessment and investment strategy. Number 2, income plan. Number 3, tax plan. Number 4, the big unknown, healthcare and long-term care. And of course, number 5, the estate plan. And all of these steps are blocks needed to build a solid foundation so you can get successfully to and through retirement. Please subscribe to our channel so we can continue to educate and empower you to make the best decisions with your hard-earned dollars. Be sure to share this video with your family and friends and those that you care most about. And don't forget to hit that little bell icon so you can be notified whenever we come out with new content from my team at Schlegel Financial. Thank you for watching. This has been the coach, Chad Schlegel, here to coach you every step of the way on this journey through retirement. Until next time.